All right, ladies and gentlemen, welcome. Let's get the panel started. I'm Francesco Guerrero. I'm the financial editor of the Wall Street Journal. Thank you for joining us. Brief introduction to the great panel that we have today on emerging markets. To my far right, John Coombe, who's the executive director of Jana Investment Advisors out of Australia, big investment consulting firm out of Australia. To my immediate right, Thomas Floor, the founder and chairman of VistaJet Holdings, the company that specializes in long-haul private jets. To my left, Chris Hung, managing director of the Far Eastern Consortium International, which is a big investor in hospitality and real estate in emerging markets. And next to Chris, Sarah Zervus, the senior portfolio manager and head of global debt at Oppenheimer Funds, huge fund. And then to the far left, Jay Pilowski, principal at J2Z Advisory, a financial firm. Jay is the only one who had the guts to tell me he doesn't read the Wall Street Journal. So his time will be severely curtailed as a result of that.
I'm already sitting over here. I'm going to be out the door here in a minute.
So the others either read it or didn't tell me they don't read it, which is smart. So well, let's start. I mean, it's a very interesting time to talk about emerging markets because for the past, at least since the financial crisis, emerging markets have bore the brunt of global economic growth. According to estimates, emerging markets account for something like 80% of global economic growth. And yet, right at this time, we're looking at people talking about, and Nouriel Roubini was doing it at the lunch panel, if you guys saw it, talking about a slowdown in emerging markets, especially those BRIC countries that have been received so much attention over the past few years. So this is an interesting moment. And here we have a panel that, as you can see, is divided between representatives of the investment world, Sarah, and Jay and John, and then two representatives of what will call the real economy, so people actually put investments on the ground. So I would like to start from this question that we are facing right now as to whether we're seeing a slowdown and a worrying slowdown in growth in the BRICS countries that have attracted so much attention. And I will start with Sarah and then Jay, whether you think that this is happening and whether we should be worried about it.
Well, every economy goes through cyclical upswings and downswings, and we're seeing that across the board in different emerging markets. So Brazil was definitely in a downswing. They are, we think, coming out of it slowly, heading into next year. Then Russia, sticking to the pure BRICS, Russia definitely heading into a downswing cyclically. It'll be up to them to enact some reforms to make a structural uptrend. India, I think we believe it's more on an upswing now, and it's really going to be helped by oil prices being lower. And China, I think there's two sides of the fence, people who worry about China and people who don't, and I just don't worry about China. And I would echo Geraldine's comments at lunch, which are growing at 7%, China still delivers a heck of a lot of GDP to the world. So in that context, we were really worried about 2 years ago, China growing at 10% was going to crash the world when they did a hard landing. So go through all, on the one hand, on the other hand, emerging markets are a mixed bag. They're not created equal. All regions aren't created equal, and even the countries within the regions have a lot of diversity. So in that context, I still am a big believer in the structural uptrend growth of emerging markets overall, but lots of wiggles around that trend.
So Jay, following up from that, so they're not created equal. So which ones should one be careful about, and which ones should people really look favorably?
Well, Francisco, you said in the green room that we should disagree with each other. So I'm going to go ahead and disagree right off the bat. Brilliant. I actually look at emerging markets as a coherent whole, and I think there are three main points that I'd want to express. The first is that the growth model for emerging markets since the late 1990s of export-led growth is broken. It's not coming back. And a simple statistic to support that fact is that the current account surplus of Asia ex-Japan peaked in 2008 at 7.5% of GDP for the region as a whole, and today it's less than 2%. All right, so the second point is that if you have a broken growth model, and by the way, the growth models in Europe and the United States are also broken, and that's why we have such a struggle globally to generate growth and to generate demand. The second point is that the growth model to replace the export-led growth model is a domestic demand-led growth model. And there, I think the interesting point is that this is going to suggest a complete flip and reorientation of currency strategy amongst the emerging markets globally and amongst the developed markets. And to wit, emerging markets for the last 15 years have focused on weak currencies to support export-led growth, and the developed economies have focused on strong currencies to dampen inflation. That has completely flipped. Going forward, emerging markets want strong currencies to foster domestic demand-led growth, and the developed economies are the ones that are cheapening themselves to try and foster demand. And there, a simple statistic would be that the real effective exchange rate of the Asia ex-Japan economies has appreciated by 15% since 2007, whereas the US dollar in real effective terms has depreciated by 10%. And ultimately, where we are ending up, I believe, is a stagflationary environment for emerging markets. And I think that's particularly problematic. The silver lining is that that will foster the appreciation of the currencies because that dampens inflation. Dampening inflation allows for domestic rates to come down and fosters growth.
So, John, there's very few countries that benefit from export-led growth model of emerging markets as Australia. So what do you advise your clients to do now when we are seeing these dynamics that these two just talked about?
We think that trade across the regions is the big growth. So from our perspective, we think a trade within the region blocks and across the region blocks is where the real growth is going to come in the next 10 years. So from our perspective, we're still bullish on emerging markets. We're still positive about China, and Australia has benefited. It's unfortunately that the companies that benefited the most wasted the most money that planet Earth has seen for a long time. $20 billion BHP blew up, and Rio's did $20 billion as well in investing in infrastructure or new investments that are going to produce zero. It's an amazing statistic, and that's the thing why resource companies are unloved today by the markets. It's because they've wasted capital. If there were other companies in the world wasted as much capital as that, they'd be unloved as well.
So, two companies that don't waste capital, right? Right here,
exactly.
We hope. Let's look, if you like, from the microeconomic perspective. Like, how do you see it on the ground, given that you have a very interesting business, right? Because it caters to essentially the affluence of a country, right? And it's a function of whether people have the wealth to actually fly and the business needs to fly. So let's start for the BRICS. I mean, how is your business in the BRICS, and what are the big dynamics?
Well, first of all, I'm very happy that I'm from the real economy because I totally disagree with the statements which were made on the left here. What we see is a very strong growth model where within the BRIC countries, it's not only about the capital, but it's about the vast hinterland of these countries. So it's not all happening in Shanghai and Beijing. It's not all happening just in Moscow, St. Petersburg. If you look at Russia alone, and for instance, we have the only foreign certificate to fly within Russia. There's a lot of business in Novosibirsk, in Petropavlovsk, in Vladivostok. And when you go actually to these cities and speak to the business leaders, then you can touch, look, and feel what they have to build in their vicinity, in their region, to bring that level of next investment to that part of the country. I'm always saying, when you see a Bombardier Global Express remotely parked in an airport in a remote region, it's not because somebody goes on holidays, okay? It's because business is being conducted in that very moment. Investments decisions are being considered, jobs are being created, and before a business leader, being it a chairman of a large multinational company or an entrepreneur, makes such an investment, he's going to go there and looks exactly what's happening in that region. And we're at the forefront of that indicator. We're flying every day in and out in those remote regions and from BRIC country to other BRIC countries. And I think that's the interesting other dynamic we're seeing, whereas maybe some 5 or 8 years ago, as little as that, there was a lot of flying between Western countries and BRIC countries. Now these BRIC countries are doing business directly. And then on top of that, if you leave the BRIC countries aside for a moment, we see a very strong dynamic for the next level of BRIC countries doing trades directly. So you're seeing Angola dealing directly with Mozambique, Mozambique dealing directly with Kazakhstan, and Kazakhstan dealing directly with Ghana.
Okay, so hold that thought, because I want to discuss the beyond the BRIC countries in a moment. But just to conclude, so you are seeing all this Bombardier parked in remote parts of the
Well, hopefully not parked for too long, because we want to fly back.
Parked but ready to go.
Yes.
So you are seeing them. You haven't seen a
Absolutely.
slowdown in business that way.
75% of VistaJet's flight, and that has been, we had 10,000 international flights in 2012 alone. 75% of those flights have not touched Western Europe or North America.
Wow, that's incredible statistic. So Chris, you're seeing from a different perspective, because you also the longer lead time of some of the projects that you do. What you're a big investor in China, of course, and other areas of the BRICS. I mean, what is your sense? I mean, if you're really seeing a shift, as Jay's saying, from export-led growth to domestic consumption, you should be seeing already positive signs in your business. Are you seeing it?
The short answer is yes. I mean, we are in the business of building apartments for sale and also building hotels and operating them. A big part of our customer base is actually from mainland China. In the last 5 years or so, we've consistently seen double-digit growth in terms of tourist arrival. So
Into China?
Outbound from China. Outbound
right.
from China.
Yeah.
And our entire growth strategy is centered around what we call the Chinese wallet strategy, meaning targeting where the Chinese wallet will go and making our investment there. At the moment, we are seeing, in terms of outbound from China, a lot of activities, in Hong Kong, definitely. I mean, the arrival into Hong Kong, we're seeing year-on-year double-digit growth consistently, and we are also projecting that it will continue at least for the next 5 to 10 years. And if you look at the Chinese tourism market, you have to understand, right, in China at the moment, the individual travel scheme is only targeted at around 300 million of population. Not all citizens in China at the moment are allowed to travel overseas. There are only certain provinces where the government has allowed them to basically obtain this individual travel visa to travel overseas. Imagine, serving this 300 million customer base. We are already experiencing such high growth. There is still a billion population of untapped demand. And as I guess the population in China becomes affluent, we will see them not only going to Hong Kong but traveling further abroad. And we are already seeing that, and that's why we are also, we're expanding into countries like London, UK, in London particularly, and Japan, and also in Australia.
What is the second most important market after Hong Kong for Chinese outbound tourism?
Well,
you see?
Yeah, I think there are really 4 countries or 4 places which, from our survey, is telling us. I think it's definitely Hong Kong, Macau is very favorite. I mean, the first place they want to visit outside of China would be Hong Kong, Macau, and then it's Australia. Actually, Australia is a big market for Chinese outbound, and the UK, not UK generally, but London in particular.
Yeah.
I think when they travel overseas, that's the place they want to go to, London, and then it's surprisingly Japan. Even though there's a bit of tension at the moment, but that is a market where if you ask privately the customers, they always say Japan is a place they want to visit.
Interesting.
Yeah, Francisco, John, what's interesting about that is that if you accept this idea of currency revaluation between the strong or between the developed economies and the emerging economies, that's hugely bullish for Japan, because the China consumer can go to Japan now 20% cheaper than he could go 6 months ago. And if you accept the idea that the yen is going to weaken further and the renminbi is going to appreciate, we were talking about dim sum bonds, maybe we can get to that later on, but if you accept that idea, hugely bullish for Japan and could be a major factor in helping the Japanese economy kind of rebound a little bit.
And let's stay with the BRICS for a second before we move on to the other markets. It's especially because South Africa has been added to the BRICS now. It's a very uneven grouping, right? So I'd like to hear Sarah's perspective on which, to your point that they're not being created equal, which countries offer the most opportunities and which ones are, frankly, lagging behind of the five.
Yeah, so I'm hoping personally that the acronym BRICS retires with Jim O'Neill now that he's retiring, because they honestly do not belong in the same group at all by any metric, whether it's per capita income, resource capability, growth potential, liquidity, you name it. So setting that aside, South Africa, in particular, I wouldn't put in that category, even though I'm a huge fan of long-term potential. It's pretty messy. That said, there's always opportunity to make money. So it's really one of my biggest overweights in the local bond space, because they offer very high yields and they have a very credible central bank. They are in the midst of a very long-term, development that has to occur in the political system. They went big pendulums going from this side to this side, and hopefully we're on the verge of tilting back and getting some more dynamic political parties there. But in that context, it doesn't mean that there are bad investments. In fact, some of the most dynamic companies are there. There's not just mining. There's consumer companies, pretty big stock market, even though we're into the debt space. Mm-hmm. And so, I put that as a definite possibility or good outlook. However, if I were to look across the emerging market space, Mexico is one of my favorites. I would argue that it's kind of emerged in a way by a lot of different metrics, but this is the first time in history that we're seeing the political parties across the board agree to major reform, and that's really exciting, and that's exciting for all asset markets. And I was very excited to go see Carlos Slim, because I'm also very hopeful that his monopoly falls apart. Yeah, and it's time to move on and really introduce some dynamism in that country. So, I'm pretty excited about finally Mexico moving from boring old 2 to 3% growth into something more exciting.
So thanks, Sarah, for taking on Jim O'Neill and Carlos Slim in the same answer. That's pretty impressive. I mean, I'm looking forward to the next one now. So, John, obviously, Australia has benefited from China's growth. What are you advising? You're advising your clients to look elsewhere in the BRICS now? Or you still think China is the place to be, or?
I suppose because Australia is close to Asia, Asia's been the focus.
Yeah.
And one of our largest clients has actually started an office up in China to actually work out which way is the best way for them to invest and to actually profit from what's happening up in the region. So I think Australia will always, because of distance, always have a focus on Asia. I mean, we've got a natural advantage on trade to Asia. So for us to look at South America is a little bit, I just think it's a little bit
too far.
Yeah, a little bit far. I mean, Argentina's the closest to us, and I don't think anyone really wants to invest in Argentina. I mean, the biggest issue for us, I think, for me is...
Oh, you please don't.
Is India, right? I went to India a couple of years ago, and they've got this unbelievable belief that they've got this demographic right to prosperity, and I just don't see it. It has such structural issues in terms of power, no manufacturing industry, and I just don't understand why they think because we educate our children and they're all young that we're going to be prosperous 10, 15, 20 years down the track. And it amuses me. I hope they're right, and I hope they get all of those people out of poverty, because it's sickening to go and see all that poverty. But you don't get out of poverty just because you've got a whole lot of young people.
That's a fair point. Thomas, it was interesting you mentioned Russia in your previous answer, because not a lot of foreign investors, I think that may be an understatement, like Russia. And so what do you see in it, and how is it as a business for you guys?
Well, maybe quite specifically to my business, the bigger the country in land mass, the bigger the opportunity. I mean, so if you fly from Moscow to Vladivostok, that's a 9-hour flight. So we like that as a business. But what Bombardier as well. Yeah. But seriously, what we see in Russia is that so far the focus was really on the capital and maybe St. Petersburg, and we see now a lot more regional investment, which does come and is guided by Moscow and by the central government, and I think that will, for the first time, I guess in many hundreds of years, will give Siberia a chance. For instance, Irkutsk as a town has been unofficially declared as the capital of Siberia, and all of a sudden you see certain region receiving vast amount of investment. So we see that as a positive. But just one other element I wanted to add to the educational aspect. What we find interesting and what we see on the ground in a lot of those emerging and emerged markets is that for the first time in many decades, the human capital is coming back to these countries. So whereas before, somebody who was smart and had the opportunity to study in either the United States, Canada, or United Kingdom, and had stayed there and pursued their career and saw more opportunity in the West, we see a lot of that human capital going back into those countries. And I think that is the very early signs of a sustained long-term growth, because the human and the smartest capital who know the local rules and the local elements of the country, and they will be the basis of further prosperity for that country, and we see that.
See it? So what's your?
Because eventually these guys become entrepreneurs. Once they become entrepreneurs, they create jobs, they create wealth, and then, given the poor infrastructure, eventually they will fly with us, and they seek opportunities way over and beyond their own country. So the traditional Western business person would feel comfortable to go to South Africa and explore Africa from South Africa. What we're saying is, let's go to Angola, let's go to Tanzania, let's go to Mozambique and Kenya, and actually do business right there on the ground rather than doing it out of Johannesburg. And in those countries, we see a lot of talent educated in the West.
Yeah. Chris, so the one obvious fear for China is always the overheating property market, right? You invest there. It's also a market that is very directly controlled or of great interest to the government. So give us a sense of where we are in the perennial boom and bust cycles of China's property market.
Just on property development, our business in China is in Guangzhou as well as in Shanghai. And these are the two provinces that where the austerity measure hits hardest. But I want to tell you a story so you know what is actually going on so far as property sales is doing, right? Now, we just launched about 500 apartments in Shanghai. This was about 3 months ago. And before we launched that project, there was a lot of internal worry about the austerity measure hitting the sales. Just so that you're aware, the situation in Shanghai is that if you are not married, you are not allowed to buy. If it's your second home, if you already own an apartment or a house, you cannot buy. And if you are not local resident, you cannot buy in Shanghai. So those are the three conditions, and they are very, very stringent conditions. You have to meet all these three criteria before you can walk into our sales office and sit down, and we'll do the sales job with you. Now, with those three measures in place, we were able to sell all 500 apartments within 6 weeks.
Wow.
Within 6 weeks. And that was, it shows how strong the domestic demand is for housing in China. And our price, is we're targeting really the mass market housing, so we're not really looking at the very high end. It's really mass market housing. But I think this example, hopefully will will give you a flavor as to how strong the domestic demand in China is. And I think the government is going to continue to put the tightening belt on, because they can't afford property prices to move up further. But from our perspective, we know that the fundamental demand is there, and they can't loosen it. If they loosen it, the price will shoot through the roof. So that's basically the situation.
Can I add on that?
Of course.
Because some of that makes me feel comfortable and some not so comfortable, right? So from the perspective of watching China and can it develop a credit bubble that bursts and takes us all down, some of that demand, and we hear lots of those kind of stories where things sell out very quickly, makes a lot of people nervous coming from Western climate where we had a housing bust. Now, a couple things make me more comfortable. One is the stringent policies. Second, there is no leverage in the system. So you have to put a lot of cash down or all cash down. And then there is the concept of real demand. So the urbanization thing that we hear about, people moving from the countries to the big cities to find jobs, those will ultimately need houses. Now, a couple things to keep in mind, though, is that why do people want to buy houses even if they're not ready to move in and so forth? There's nothing else you can put your money into to save in China. That's not a good thing. So while I'm, said in the beginning of the talk that I'm pretty comfortable with the outlook in China, there are a lot of imbalances. And one of them is not a great functioning capital market. The banks are in, very, exposed through to local government and property and so forth. There's not a nice, well-diversified portfolio. NPLs are growing, et cetera, et cetera. Now, so those caveats of no leverage and there's a healthy demand waiting outside the city to buy those can be offset by those factors. So I think that, that is one key area that we are all watching for reason. Is that property market, and I agree, they will not loosen those policies anytime soon.
Sarah, there's a huge domestic bond market in China, but it's not open to the foreigners.
No.
So you as an investor, are you looking forward to that opening up?
Well, there's a price for everything. So, what those interest rates show me now is those aren't really market interest rates because it's a captive audience.
Yeah.
So at the current price where I'm not allowed in, I would not buy those bonds. However, when that time comes, I'm guessing there'll be some interest rate liberalization. They're trying to get the currency more convertible, and then we'll do the homework on the balance sheet.
Yeah, let's talk about for a second about the convertibility of the currency, of the Chinese currency, because it's been a big issue, and I would argue it's come a long way in the past few months actually. And so, Jay, I mean, how interesting is that to you? I mean, the ability to buy and sell renminbi offshore and to invest therefore in local currency there.
Well, I think local currency debt is what's probably most interesting in emerging markets in terms of, broadly speaking, public market investment opportunities between equity and dollar-denominated local currency debt. Local currency is the most interesting because of the appreciation of the currency that I think is going to happen as part of the domestic demand shift to that growth model. And within that, China is obviously a key story. And I think dim sum bonds, which we were talking about in the green room, is an area where, as a foreign investor, you can get a couple hundred basis points premium because it's China, local China, in foreign companies, and you also get a play on the currency. And so if you think that the currency is going to appreciate as it has been, it's the strongest it's been in 20 years versus the dollar, for example. If you think that currency is going to continue to appreciate, well, then that's the kind of thing that you can get. Now you're taking a 3 or 4% return, you're making it a 6 or 7% return, maybe you put some leverage on that, and then all of a sudden you've got an 8 to 10% return, and you're starting to talk about, an area of opportunity. And I think one of the keys for me is that going forward, the opportunity to have regionalization, and we touched on it a little bit here, but I think the next 5, 10, 15 years, the world is going to be moving to a much more regional construct where Asia, the Americas, and Europe really work amongst themselves. And then I think 5 or 10 years down the road, 2020, 2025, you're going to add a fourth pole. I call that the tripolar world. I think in 2025 will be a fourth pole of the world, and we'll have Africa in there, because that's really an area of opportunity that I think Thomas talked about it from his business. I think we're starting to see it in the investment side. For example, there's a Nigerian ETF. You know, if you want to buy as a New York, based investor as I am, and you want to buy Nigeria, you can just go buy an ETF on the New York Stock Exchange. I mean, that's pretty amazing, and that's only going to continue and expand over the next 5-10 years.
Before, I know you guys are dying to talk about anything other than the BRICS, but I just want to ask one more question. Chris, you've actually raised some money, I think, on a dim sum bond, right, recently. So what's the advantage of that? Because I can easily see what the risks are. You're tying yourself to a currency that is basically government control, and yes, it's been appreciated. It could also easily depreciate if they decide that it's the right thing to do. So why raise money in that market?
Yeah, I think before I answer that question, I just want to say, right, before we decided to actually tap the dim sum bond market, we actually looked at the US dollar market, and we did actually a roadshow sounding out the US dollar investors. At the end, right, we decided to go with the renminbi bond because with the cross-currency swap, you end up in a interest rate which is actually lower than the US dollar market. That's really the reason now. And the market for dim sum bond, right, has changed dramatically over the last 2-3 years. 3 years ago, we wouldn't be able to do a 5-year tenor. And in terms of size, there is a limitation. You see a lot of issuance at the 500 million renminbi level. This year, when we did the deal, we were able to do both 3 years as well as 5 year, and the size we could get to a billion. And in fact, in total, we raised 1.85 billion renminbi in the offshore renminbi market. Now, when you look at the domestic renminbi or the domestic debt market versus offshore debt market, it is a due. There is actually a discrepancy between whether if you are a state-owned company raising it or if you are a private enterprise raising renminbi in China. Now, the interest rate, the PBOC rate in China is 6%, and normally for private enterprises, if you tap it in the domestic market, it's actually substantially higher than this. It's probably 30% higher. When we did it, and if you are a state-owned enterprise, you can get a much more favorable rate tapping it in the domestic market. In our case, if we were to raise the money in the domestic market, the interest rate would be much higher than to raise it offshore.
Right.
And if you do it on the cross-currency swap basis, you're actually not exposed to the fluctuation of the renminbi. So it is actually quite an interesting dynamics at the moment, with a lot of arbitrage activities that you can take advantage of to lower your overall cost of funding. And from a corporate perspective, actually I was wondering why investors would rather pay a lower rate investing in renminbi than to buy a US dollar bond.
Why? Any thoughts?
A couple things that you said crossed my mind. First of all, welcome to quantitative easing, right? So you had this great opportunity to raise a lot of money at low rates, and that's part of quantitative easing, which generally is helping corporates across the world, and it does help our returns in the sense that yields are falling, hopefully on the bonds that we already own. But in the same context, going to a little bit of the regionalization topic, people are more comfortable. I'm going to generalize, but I think it's true. People are more comfortable investing close to home first. So the home bias that we talk about. So Americans tend to feel most comfortable in America, and then they branch out to maybe Canada, and then now Mexico's kind of being considered. Same thing in Asia. So what's close to home, better because you've probably seen the people more and you understand the business a little bit more, and that's why I think Australia's got this great edge there. So in that context, when we actually decide what bond we're going to own, we separate out the interest rate risk, the currency risk, and the credit risk. So I can take, that company exposure, hedge out the currency, and just take the credit, or vice versa, any of those three combinations. So we try to look at it more holistic and say, well, where do we think that Chinese currency is going. And is that going to be a better return than Australian dollar or the Brazilian real or Mexican peso? So that kind of builds up onto the portfolio side.
Gotcha. Okay, so let's move beyond the BRICS. So, John, if I told you couldn't invest in the BRICS, where would you advise your clients to go in emerging markets? What is it that's most interesting to you outside the BRICS, the traditional BRICS?
I think Indonesia looks really interesting. Large population, very young, well-educated, opening up. Got much better government now than they've probably had for 30 years. So it's an exciting, and the growth rates are taking off. The only trouble there is the infrastructure's poor. So from an Australian perspective, we'd probably want to get involved in the infrastructure spend.
Right.
So it looks very exciting.
So you stay close to home, right? I mean,
That's
Indonesia
very
is
close to home.
right? Even closer.
That's close.
Nothing else further afield. I mean, Carlos Slim was making a passable case at all.
Look, some of our clients are very interested in Brazil. Like they think Brazil, with the World Cup coming and the Olympics coming, that it's an exciting place to be invested. It's how do you invest there? If you're not a local, are you going to invest in the property market, or are you going to invest in the bond market, or are you going to invest in the equity market? Well, the equity market looks a bit expensive. The property market looks interesting because you've got this growth in demographics happening. So but that's full of regulation, and you better know and better partner with somebody who really knows what they're doing. But the entrepreneurs, definitely in the property market there, and then you've got the infrastructure spend that will happen around the Olympics. So, but everywhere you look across the emerging world, they're spending money on infrastructure. The West isn't. So if you're interested in infrastructure spending, interested in toll roads that are going to just be this annuity stream forever and ever and ever for your pensioners, you've got to get excited about the infrastructure spend that's happening right across all of the emerging markets.
Yeah, and as a public investor, the challenge is there's so few instruments, that you can access, and therefore you've got that elephant through a keyhole opportunity, which if you can get there, presents huge opportunity. And there's a couple of publicly traded funds that not only do you capture that opportunity for capital appreciation, you're picking up a 4 or 5% yield per annum, and so you have Brookfield in Canada, and your Macquarie down in Australia, those are some vehicles that, boy, if you've been in there for the last 2 or 3 years, you made a ton of money.
You're talking about infrastructure funds, specific infrastructure funds in emerging
I'm talking about BIP.
Yeah.
Please buy it and push me up a little bit more.
Yeah, okay. End of commercial. So, Thomas, you're actually in a highly regulated industry, in the sense you have to go through a lot of permits, I'm sure, and licenses and so on to fly in these countries. So how do you assess the risk and reward of some of these, what people call frontier markets, right? Because, yes.
You would see the infrastructure spend.
Absolutely.
Yeah. So, and where do you see the opportunities lie that outweigh the obvious risks that some of these countries present?
Well, first, as we said, the infrastructure is quite poor. That goes from airports to railroads to roads and so on and so forth. But it's being built fast. I mean, if you go to Nairobi as an example, because we want to go a little bit beyond the BRICS here, I'm going there since last 10 years. Every year you're going down there, you see more infrastructure being actually done. And I think the turning point has been reached as far as Africa is concerned. They're really serious about it. They want to get people out of poverty. They want to build communities. They're investing into education, into schools and so on and so forth. And you see it across Africa. And before, maybe you saw it in 1 or 2 countries, depending on the flavor of the politics in that country. Now you see it right across the continent. And I personally believe that the risks are limited. Now, we fly in and out, so we do not invest into brick and mortar and have the the actual investment stuck in that country to that extent. So maybe the risk for us is slightly less. But I'm looking at more from a holistic point of view. I see that these countries are serious about democratic advancements in the way they treat their citizens. If you look at the recent election which we had in Nigeria a couple of years ago, it was praised by the Obama election as the best one in Africa ever. Nigeria as a country has 170 million inhabitants. Russia has 130, just to put things in perspective. They're investing. And the question is, as a foreigner, to what extent can you be part of that? Okay. And you always need, like with anything you do, you need a strong foreign partner. But as a foreigner coming to the United States, you probably also need a strong foreign partner. So I think I have a fundamental slight problem with that general concept of national and international. I'm Swiss. Everything outside Switzerland is international, if I want to use the same concept here. I think we got to open our mind and actually go to these countries and see what is being built, on how people are serious about building their financial infrastructure. In Nigeria alone today, I could name you 6 or 8 global, truly professional banks you can do business with, something which wasn't the case 5 years ago. And those are the elements where I see the opportunity, which makes me very bullish that this is there for the long term. And given the global media opportunity today, these countries cannot hide behind old concepts of being less transparent than the rest of the world. And I think from every angle, those are elements which I believe drive those emerging markets to the forefront and potentially the next BRICS. But on a much broader scale, 10, 15 countries are going to be the next BRICS countries, allowing us to see substantial economic growth.
Over what period do you think? How long does it take for them to get to that level?
It's happening every day. We see it every day. It's improving every day. The reverse gear is not there. We don't see any reverse gear on that development. And until you have a Western kind of standard or a standard you see today in some of the ex-BRIC countries, you're probably looking at 3 to 5 years. But every time you look back, you said, oh my God, I missed an opportunity, which was there 2 or 3 years ago. And I want to share one data with you. 3 years ago, a very good client of mine asked me to come to Nigeria, to the west coast of Africa. And that was end of 2009, early 2010. And it was kind of the last thing I wanted to do, given the economic environment. And I landed in Abuja, and there were 2 business jets. 6 weeks ago, as part of our global roadshow, I departed 4 o'clock in the morning to Kinshasa, and there were 43. Okay, so that's the kind of, and again, we have to eliminate that idea that business jets has something to do with Hollywood. Okay, those are business tools which help the leaders and the captains of the industry to be more efficient. And also between the African countries, there's a very strong competition for investment, for opportunities, for foreigners to come in. And the leaders of those countries need to see what the opportunities are in the other neighboring African countries. And that's what those business jets are being used for, to explore those opportunities.
Your company's in a great position because as an outside investor who travels in between these countries, you can't actually travel between these countries without the private jet. You go to South Africa and then come back, and then South Africa and come back, or Europe and come back.
Exactly.
So I do agree it's a leading indicator. Huge. These aren't your grandpa's emerging markets anymore. So from the context of, say Rwanda actually issued a bond, I think it was last week.
Last week, yeah.
And even a very seasoned emerging market person in my firm, also knows my boss, said to me, what the heck, you're thinking about loaning money to Rwanda? And I said, well, I was actually thinking of going there for fun and seeing the gorillas a few years ago. He's like, G-U-E-R-I-L-L-A-S? And I'm like, G-O-R? So the point being that there are a lot of changes. I know it took a while, right? There are a lot of changes going on across the board, and there are a lot of challenges. So it's not easy to get into these countries. They're working through their own infrastructure issues. They're very, very welcoming to the businessmen on the private jets. If you're a regular citizen, even with several $billion under management, it's still difficult to get a visa to get into Angola. You know, these things are growing pains, and they'll change, but you know, they have commodities. If they spend that money wisely, there's going to be some major growth opportunities.
Well, and the other thing, unfortunately, you know, for the investors in the room, a lot of that opportunity has already been exploited. If you look at, you know, particularly Western Africa with the energy, you could have bought Angolan government bonds, you know, 6-7 years ago at 14 cents on the dollar. Today they trade at like 88 to 90 cents on the dollar. So a big part of that, the opportunity is still there. But it's probably more there on the equity side than on the fixed income side. But it's the real 10-time moneymaker opportunity is already passed, unfortunately.
But that was the distress opportunity, right? That you're buying really at bargain basement prices. But I suppose there's an argument to be made, and Thomas was making it, was that you can actually now ride the growth in a more normal.
But the problem is, as we know, and we see from China and elsewhere, is that there's no correlation between growth and stock market performance. So, you know, just because there's economic growth, Thomas can do super well, and I think, you know, it's real exciting what he's talking about. But as an investor, you know, that's a much harder game to play.
Well, I think there's a certain cycle to this, and whereas the BRIC countries or BRICS countries kind of ruled our thinking for the last 10 years, and I'm very happy that we kind of want to move on from the BRICS. Then you have a certain region like West Africa where you saw those opportunities. If you ask me today where the next West Africa is, it's going to be East Africa. Mm-hmm. So if you're looking at your 5 or 10 time returns, now I'm in the real economy. I don't know what instruments are out there, but if you want to hear from what I see as the leading indicators of where the investments are about to happen, it's going to be Tanzania, Kenya, Mozambique, and Uganda.
So, Chris, unlike the others, you do put stuff on the ground. You do have long-term projects. So, are you thinking about any of this for your business, or is it too early?
Well, in real estate investment, I think there are a few things which are very important. I think in terms of the land law has to be strong enough, or it has to be there to protect, you know, investor, because we are putting things on the ground. So, and there are enough opportunities that we can go after. So, you know, in that regard, you know, we tend to want to focus on the area that we are familiar with. So if you look at basically the places where we invest, Australia, Singapore, Malaysia, Hong Kong, the UK, they are, you know, English jurisdiction where we feel familiar with. China, because it's you know, it's a very big market. So these are, you know, I guess from our perspective, the opportunities are plentiful in those countries. So we're really not looking at anything outside that.
And let's reflect for a second on this issue, the entry point, right? So we can all see the prospects, right? But if you mentioned the Nigerian ETF and you mentioned the Rwandan bond, but as a public market investor, so how many opportunities do you have, and what can you do to take part in this growth? Say, let's take East Africa, for example. What is it that you can do there that where you can actually buy meaningful size assets?
Well, there's not many opportunities, but they're coming quickly. I mean, there is an Africa ETF, but it doesn't really trade all that widely. You can't really put huge amounts of money in it. You can buy individual stocks. I tend to do mostly ETFs. So for myself, I do own that particular ETF, but the problem is it's 45% Egypt. And you know, Egypt's got major problems, so it's a little tough to get too excited about it. But there are increasingly, just as you know, you saw Latin American funds develop, and you saw Asian funds develop. And you saw Eastern European funds develop. You're going to see African funds develop. As I said, the Nigerian ETF is probably less than a month old. It's happening.
Mm-hmm. Are you seeing it in the fixed income
Fixed
space
income
as well?
side. So local currency markets, again, these are all in infancy, but we can get access to them. And when there are some interesting, especially double-digit type yields, we do the homework and check out the currency and get involved in that. But one thing we haven't mentioned is the growing corporate debt market, which it hasn't hit Africa in size like it is Latin America and Russia and so forth. But you know, there are some really high-quality corporates that I think would be if you were going for the really juicy returns, they're not going to be low risk because they haven't been tested and so forth. But whether it's the small loans like $1 million to the more well-known companies, the $100 million, I think that's the next wave across emerging markets.
Yeah, I just want to add, the thing that people want is growth. That's what the investor base wants. And so Africa offers growth. 7 of the world's 10 fastest growing economies are in Africa. And so that's what's going to drive the vehicles to create the opportunity for public investors to get in there. And you just look at Japan. Why has Japan done so well? I know it's not an emerging market, but it illustrates the point of people want growth. Japan is demonstrating it's going for growth, and the stock market's up 60% in 5 months. So Africa presents growth, investors want growth. Pretty soon money managers and people who create ETFs and vehicles are going to launch vehicles so that people can participate in that growth.
And
we'll speculate on the growth. Because you've had growth in China, but you've had nothing out of the stock market. So
I agree with that point. But I'm just saying that in terms of the instrumentality,
they'll speculate for growth.
Yeah, in terms of being able to find ways to get in if you want to get in. Totally, there's nothing that says.
But the
just
trouble
because
is, if
grow,
you're a big sovereign fund, how do you, if you want to invest in East Africa, you own East Africa.
Yes.
Right. So it's all right for a hedge fund or a small fund to actually say, well, we're going to go into East Africa and we're going to do this. The reality is the big money, the big sovereign fund, the big pension funds in the US, etc., they're just too big and it's too small.
Absolutely true.
It just makes no difference.
But that's where you have that next tier, not the BRICS, but the Turkeys, the Mexicos, the Indonesias, the Nigerias. There is a whole, emerging markets are tiering from the ones that we know so well because of great marketing, not performance, and the opportunities in the next ones, and then the frontier. They're all there, and those are the ones I think, John, and particularly in infrastructure. I mean, the big pools of money are investing in infrastructure because they see the opportunity and because it matches what they're trying to do in terms of their liability and their timeframes.
In that second category, so not the frontier markets, but
well, it's all the way through.
Interesting,
all the way through.
The investment in the infrastructure in the emerging market world is private equity. I want 25% returns because I'm taking on all this additional. Your property portfolio, I want 25% return out of that, right? Whereas what you're seeing is the big sovereign funds buying British Airways or airports, British water assets, huge assets in Europe, etc., where it's big enough to really get invested in.
Well, let's take India. If they would open to that kind of investment, they want it. People want to put the money there. There's a huge amount of money that you could put to work in India infrastructure, and that would solve your problem that you mentioned earlier. We have human capital, we need physical capital, put them together to grow.
But no one trusts the government.
Well, no, the government's just not opening it.
Yeah, well, you don't trust
bureaucracy. I don't even think it's trust, it's bureaucracy. So again, there's lots of things that can be fixed, which would, you want to talk about India growing. Get that one right.
Right, but the fact that they're not means that money's going to go somewhere else because there are growth opportunities, and right now people need and want growth, particularly from the equity side. I mean, it's somewhat right. You just want cash, and I like cash too. Don't get me wrong, but from an equity perspective, you need growth, and even in the emerging world, as I mentioned at my top comments. The growth is not really, for emerging market standards, it's pretty mediocre.
Although on the plus side, it's just one data point, but their Rwandan bond was hugely oversubscribed, and the yield that they ended up with it's an incredible yield. I mean, I think to your point, Jay, that people, when the opportunity is there, people do take it, right?
But isn't that exactly what China has done over the last 4 or 5 years, investing tens of billions of dollars in Africa.
Sure.
And they were the early ones in, and they are the ones with a 5 and 10 times return, either on money they were lending or on equity opportunities. And they've done whether the Africans liked it or not, now there's a different trend where they're saying, don't come back as imperialistic forces, but the fact is that the huge injection the Chinese gave the African continent over the last 5-6 years was an extremely smart move from the Chinese side and helped Africa to get jump-started.
I'm not sure they're making money from those investments. A lot of those are really policy loan, where they
And they get commodities. They get commodities
Yeah.
in return.
They get, you're talking about the big infrastructure?
I'm talking about the China investment
commodities.
into
Yeah.
the African nations, right? I mean, it's really a barter kind of
Yes.
trade, right? I mean, the
They're
interest that
they're selling a lot of equipment. If you go to remote airports in Africa, and you know, we flew last year to over 140 of those. You'd see Chinese equipment.
Yeah.
You see Chinese infrastructure, and where Chinese products are being sold abroad, and has helped certainly some of the export related companies in China.
Jay, you had a point, sorry. It was...
No.
Okay. So let's talk for a second about the currency wars and what was once known as global imbalances between the developed world and the emerging world. So are you guys concerned that we're in for a currency war in which, in fact, paradoxically, the emerging market currency are going to appreciate? I mean, is there, should we be concerned about this with all this quantitative easing coming from the developed world?
We're living it every day. I mean, we in the markets that are investing in these currencies. So I think many panels that we've seen over the course of the day have alluded to the fact that, okay, let's just take Japan. You know, Japan's going to out Bernanke, and they're going to be, you know, if they get what they want, you know, there'll be massive amount of Japanese funds going chasing yield in the rest of the world, and a lot of that yield is in emerging markets. So in that context, you know, while we're all obviously very big fans of emerging markets, the door in and out to emerging markets is still small. And you know, a lot of countries are doing what they can to try to throw sand in the gears. I mean, Brazil, I'm a huge fan, but they don't want anybody's money. You know, so they're trying to keep that fixed income flow out and so forth because of the currency effect. So I think that we're in the midst of it, and it's going to last as long as quantitative easing lasts.
Yeah, I think personally there's a big risk of currency wars and beggar thy neighbor strategies because there's no growth. And the lack of growth means that people have to cheapen themselves, particularly in the developed economies. In the emerging economies, I actually see it more of a silver lining in that it will allow them to dampen inflation and stimulate their domestic demand profile by cutting interest rates. And you're starting to see that. Mexico is the classic example, right? Very strong currency. They cut rates, and they're going to try and stimulate their economy. You can see it in other countries as well. So I don't see it so much as a real problem for emerging markets. I think your point about the door being small does mean a risk if money does flood in. I'm skeptical of the idea that Japanese institutions are going to pour money into emerging markets. That's Japanese retail, maybe. The famous Mrs. Watanabe, maybe. But the Japanese institutions, they're not risk takers, and they can do very well. Let me give you a quick statistic to illustrate the point. U.S. Treasury bond returns, year to date, yen terms, up close to 20%. They don't have to go to Turkey or Indonesia to get high yield. They can do it in the Treasury market in the United States as long as the currency continues to weaken.
But the last thing that any emerging country wants is a currency war with one of the bigger nations. We saw it in '94, you know, in Asia, where money flooded in and then it flooded out, and it caused immense pain through the tigers. I mean, all of those have got a collective memory. They don't want that to ever happen again. So no one wants a currency war. I don't think the West wants a currency war. And a currency war means stop of trade. It means that I lock up my border and I stop trading with people. Everyone has seen what trade does. It creates wealth across the globe. We need trade. If you want to be affluent, you have to trade with other people. You cannot just create it internally and hope for the best. Unless you're lucky like America and you're blessed with all the, you know, wonderful farmland and all that sort of stuff, and you know, most countries aren't. So you have to trade, otherwise you go backwards.
And then one final question before we get to the last question. So is it possible, if I take your arguments and see the flip side of it, is it possible that all this popularity of emerging markets is just a byproduct of the search for yield, so a byproduct of quantitative easing? And when the central banks eventually withdraw from this unprecedented experiment in stimulating the economy, we will see a withdrawal of interest in emerging markets, and therefore investors will be caught out. Is there a danger of that?
There's two parts to your question. The first one is it just a search of yield? I'll go back to fundamentals. Line up any indicator you want to look at a balance sheet of an emerging market against that in a developed market. Hands down, EM wins. So regardless, right off the bat, I would argue that given the risk that's embedded in emerging market balance sheets, you're getting paid a heck of a lot more than equivalent in the DM space. So that's number one. Second, will emerging markets be hurt by withdrawal of quantitative easing? Probably. But what's probably going to happen before that is, remember, all countries don't operate with correlation one of their monetary policy cycles. In fact, we've already had Brazil since '09 hike hundreds, cut hundreds, now they're hiking again. So by the time we, let's say 5 years from now, see withdrawal of liquidity from the Fed and so forth, my guess is a lot of emerging markets have already been booming, and in that context probably already raised rates, so that when that gradual tapering off that the Fed promises occurs, we'll have a nicer, healthier spread of yields in the EM space.
Yeah, and the point I would just add to that is that emerging markets have become much bigger, and they've become much more important to real money investors. I mean, 94 and 98, it was speculative developed market money that went in and had no real intention of staying. And today, it's a totally different environment. I mean, there is some of that, but it's dwarfed by the people, like even the sovereign wealth funds, the Norwegians, who typically lead the sovereign wealth space. They're one of the most respected. They have a dedicated allocation to emerging market equity, and they just launched one for emerging market debt within the last year. So that's a difference maker. I don't personally think that even if we have continued inflows into emerging markets, we're going to have the same kind of reversal risk that might have had 10 or 15 years ago.
Okay, unfortunately, we have very little time left. I would like to end with a very, very quick round for each one of the panelists. Give us the one thing that you're most optimistic about, one thing country asset, and the one thing country asset that you are least optimistic about, most pessimistic about. John.
Oh, gosh.
Start with someone else.
Most optimistic, I think the Chinese equity market may go for a big run.
Okay.
It's a big call.
Yes, a big one.
I think it's because they've been on a squeeze of commodities. They've been paid too much for commodities, and they've been squeezed on margin, and I think that's going to reverse. So that's my positive. And the thing I'd worry about Africa, because actually the one part of Africa, well, it's not Africa, the Middle East. We haven't mentioned the Middle East. And it's interesting, we've gone through the whole of a talk like this, and that's the thing that worries, I think, most people, is it's so unstable.
Geopolitical
and it's a
risk
geopolitical risk,
in
and who knows what would happen.
Fair enough. Tom?
I would agree on the latter part. Geopolitical problems are a big risk and beyond the control of central banks.
Yes.
To that extent, the biggest opportunity is that I believe we're sitting since about 2004, 2005 on a century-long mega trend, and this is that the dominance of the Western trade has ended. And what has started is that countries which have never traded before are trading now directly. And I think those opportunities will need to be explored. That might not be something where there is immediate great returns within 1, 2, 3, 5, or 10 years, but it's something which is here to stay. There's no reverse gear on it. And we're looking at a world national, patterned network of trade anywhere around the globe, wherever capital sees the next opportunity. The participants are now everyone, and it's not just the West or maybe 1 or 2 lucky countries which were on the early list of the BRICS.
Great.
Well, I'm most bullish about the consumer sector, especially those that is targeted at the middle class in the emerging market. I think you got a long way to go. I think we are still at a developing phase of that market, and the potential for long-term growth is significant in the consumer market targeting at the middle class in emerging market. Most negative, I suppose, Europe.
Fair enough.
So we all agree structurally we love emerging markets. So let's think tactically for this year, risk adjusted, hands down, emerging market corporate yields in both high yield and high grade are my favorites, and particularly Russian and Brazilian corporates. Negative, I would not touch Argentina with a 30-foot pole. Risk adjusted returns, yeah, no thanks.
Okay.
Local currency, emerging market debt is my favorite over the next couple of years. My biggest concern would be that the transition from export-led growth to domestic demand-led growth, which historically is very difficult, really becomes problematic for emerging markets, and we have years of subpar growth and therefore subpar returns, particularly in the equity space.
Great. And on that note, I want to thank the panelists for a great panel. Thanks. We learned a lot. And thank you. Thanks, guys. Thank you. Oh, thank you. That was great. Thank you.